Good morning, traders. It is Tuesday, October 28th, 2014, 8:02 a.m. Chicago time. Thanks for joining me. Derivatives trading involves substantial risk of loss and is not suitable for all investors. My personal opinions, market data, and recommendations subject to change without notice. Past performance is not indicative of future results. A few things to cover this morning in our prep session here. Key news driving that drove some of the trading overnight in Europe is the Swedish central bank, Riksbank, cut its repo rate by 25 basis points to 0.0%, more than expected, and citing inflation concerns. Germany's September import price index month-on-month came in at plus 0.3% versus negative 0.1%. expected. Year on year, it came in at negative 1.6% versus negative 1.9%. So some positive news out of Germany. Little increase in import prices. Japan's October small business confidence came in at 47.4 versus 48.5. And overall, the market is in a cautious stance. September's durable goods orders came in at negative 1.3% versus plus 0.5% expected. A pretty big swing of negative 1.8% from expectations. That's pretty bad. Durables ex transportation came in at negative 0.2 versus positive 0.5%. The result of the release at 7:30 of durable goods is a very quick drop in the S&P 500 by about 5.5 points. Caution reigns ahead of Wednesday's FOMC decision. The market's expected to be in a holding pattern this afternoon and tomorrow after the open. The meeting starts today, actually. It's a two-day meeting with the decision at 1 p.m. Central Time, 2 Eastern, tomorrow, Wednesday. New thing I want to include in this is to tell you what the S&P fair value is for the day. The S&P fair value is negative 6.3. What this means is the price of the futures is 6.3 points below the S&P index price. So if you're trading spiders or if you're using the S&P index, the SPX, to do your homework, the fair value adjustment to the futures is negative 6.3%. Normally the futures are valued higher than the cash, but they're not in this situation because of a thing called backwardation. Backwardation is caused by the fact that interest rates are lower than the dividends being paid out by the S&P 500 stocks, causing the S&P futures to be cheaper than the cash alternative. Looking ahead at economic releases, 9 o'clock Central today. It's about a half hour after the cash open. Expecting October Consumer Confidence Index looking for 87.0, prior's 86. Again, looking for 87.0, prior 86. This is a medium importance number. Also at 9 o'clock, expecting October Richmond Fed Manufacturing Index, expecting 11 versus prior 14. That's a low importance number. At 10:30 Central, Treasury's selling 4-week bills. At noon, the Treasury selling 29 billion in 2-year notes. And then at 6:50 p.m. Chicago time, Japan's September preliminary industrial production month-on-month is expected to come out, expecting 2.2%. This is a medium importance number for Japan. Let's take a look at the charts and discuss yesterday. I'm going to start you off with how things looked around when the Trader Bite was done yesterday. And I want to walk you forward through this. And the point of this little exercise is to not only give you the answers as far as what I see, which are just a best guess, as trading always is, just a best guess based on contextual read and probabilities, really. But yesterday, our trader bite ended somewhere in here. The market ended up pushing the low, and the expectation, the plan for yesterday, the key trade idea for yesterday is, given the configuration of how this is shaping up, and as always, you can always go to youtube.com /user/FuturesTrader71 to view yesterday's video and see what was expected prior to the market and why, and then see what actually happened in the market, so that you get an idea of how things play out. Also gives you an idea of whether or not you should even tune in. But hopefully you're finding this useful. So with the low put in at 48 on the open, the expectation yesterday was for the low to be taken out early. The expectation is for responsive buying to come back to 53.75 as it was respected here overnight. This is the most valued price from Friday. So the expectation was for a retest, responsive buying back to 53.75 as part of the primary hypothesis, or the key idea of the day. But the main target for the day was 1962 being a naked point of control and acceptance from way back. I believe it was October 9th or October 6th or something like that. I don't remember the date. But 1962 is expected to be the price to be tested. This is built on the idea that the market finished the week, a pretty strong week, 85.5 points in a day session alone of range last week. The normal range is around 30 to 44 points. So we pretty much doubled the normal weekly range last week, and we finished the week right on the high, basically 2 ticks below the high of the week. And the expectation is for this to continue once we've absorbed the IFO news that came out from Germany, basically showing weakness in that economy, further evidence of weakness in that economy. So the expectation is for the U.S. market to take that news back and carry this, continue this trade here at 16.25 and continue higher. Here's what happened. Market opens. We determined the opening swing to be at 52.75 to 49.25, and then it takes out the low as expected. There's a test of the low, and puts in a low at 45.50, and then finally gets the test down to 44.50. Finds buyers, very strong reversal bar here. Finds buyers and starts walking its way back up. The test of 53.75 is done, so the responsive buying comes in as expected and pushes. The next target is 62. The expectation is that it would chop into that because of the influence of the negative news overnight. Treasuries were higher yesterday in Europe, so there's a little bit of risk aversion there. So it's expected to struggle, and here it is struggling a little bit. Pushes up to 59 at 59.25 early on, and it has this odd rotation down. So it became hard to read when this happened. That was not expected. So here it could have dropped further as it pushed into the OS. Once the market pushes into the opening swing, the expectation is that on a lower bar, whatever time frame you're looking at, we're looking at a retest of the entire opening swing down to 49.25 statistically. Pops out of the opening swing and continues to battle right in the middle. So a lot choppier than expected, and just sat here most of the day. So I still held on to the primary hypothesis that 1962 would be tested, but it just sat around all day, and it just looked more and more unlikely as the day progressed. However, a plan is a plan, and I've got to look at things from that side until the day is over. Finally, it rotates back up and puts in a high at 58.25, still short, still about 4 points short of what was expected to be tested. The 62 puts us right here on this overnight, and it's just it just seemed like it was something that would be fairly attainable for the market. Yesterday's trading was pretty low volume on a relative basis compared to a 20-day median. The overnight session kicks back in, and finally the market does its thing and pushes right into the 62 target, but it does so on the open of the European markets. So here it is at 61.25, and there's 62 finally hit. The Swedish news kicks in, and there's the news of the Swedish Riksbank kicking out the news about the drop of 25 basis points, which is much higher than expected by the market. Market pops up, and it pretty much sits sideways from that news until we get to the durable goods. Durable goods dropped the market from 1968 to the mid right here. At 63, there's the mid of the session, and durable goods pushed the market down through and has put in some weakness, and now we're testing the 62 and probably the 60.25 from the top. Overall, the high here seems okay. It's not a weak high. It's not a great high. The point of control is not up against the high at all. So this has made it with the durable goods. It's made it very difficult to read. So we still have a gap. Yesterday's close is down here at 57.25. Notice that the cash close and yesterday's point of control are both at 55.50. I'm sure some of you will recall 55.50 was a key price that I talked about yesterday and for the last week. 55.50 was this low that was put in. 55.50 was a key test area coming back, and then the idea is if we push into and over 55.50, we would likely start trading into this balance zone here, and the key price in this balance zone is 87.50. So the idea here was 55.50 from below is likely to be tested and rejected, and we did that last week. I believe it was on Thursday. We pushed right into it up to 56.25, so we pushed in by 3 ticks and immediately sold off. Friday pushed into it early and sold off, and then finally later in the session it came in and pushed to 60.25, taking that back. So now we start to target, we start to expect that the market's likely to test these bigger areas up higher. 1980, and the key price up above is 1987.50. So the shorts are really getting hurt by this. So here we are trading 63.75, 63.50 with a gap up, and likely to test the prior highs from the top. Yesterday was an inside day, as I said, fairly low volume compared to the prior days, 1.16 versus 1.27, 1.67 on the day session. So volume is dropping off, but then so is the VIX as well. So if we look at the VIX, and I'll show you the put-call ratio in a minute, the VIX is right back into line here. So here's what we've had. The VIX has been compressing for a while. It actually dropped below the compression lows, and then it finally broke up, and it's right back in the middle of this compressed area, and it's expected, the VIX is expected to continue to drop lower in this environment. A quick look at the fundamentals. Again, charts looking pretty good. Long-term, longer time frame traders are holding tight on the long side. They're still kind of winning the game. As you recall, a couple weeks ago, I talked about the fact that the 52-week lows are exceeding their second standard deviation limits over 1,400 days. And when that's happened in the past, we've had a reversal. And I pointed that out up here. I believe the reading was 1666 on a 52-week high, and I'd said be careful, this often marks a bottom. As we've seen back here, this marks a bottom in the S&P. We've also seen it mark a bottom when it's poked through back here. That's a 52-week lows exceeding the second standard deviation. Put call ratios dropping along with the VIX back into the first standard deviation. This lighter color in here is the first standard deviation, or 70% of the time we're expecting the put call ratio to be right in there. So if I squish this, you'll see that most of the time the put call ratio is right in that band. The darker band is the second standard deviation. That's when I start to pay attention. The second standard deviation represents 95.45% of the data set. So when it's exceeded, the expectation is it's only supposed to be exceeded less than 5% of the time. So when it pushes out of that, I start to pay attention. Of course, I don't take that in a vacuum. I look at that along with other indications what the overall context of the market is. Let's look at what we're looking at for today. Today we have a gap up. If we stay up here, I want to point out to you actually from the overnight chart that we've established what seems like a local resistance level here that I'm going to be looking out for, and that's 65.50, 65.75. You recall the high of yesterday's overnight session was 65.75. Once we pushed on the news of Sweden's central bank, we basically pulled back to that level, 65.50, 65.25, and have held in this area until we've fallen through. This level now represents minor local resistance on the way up. So if the market decides to become initiative on the open, meaning moving away from value. Initiative trading means participants are initiating a move away from value. Responsive trading means participants are responding to the fact that the market's above or below. So responsive does not mean selling. Responsive is relative to where we are. So if we gap down and the last day we had value up top, responsive would be buying. If we gap up and the last value was below us, responsive would be selling. And so think about it in other terms. If you're holding a position, long into from yesterday, and you came in and you saw that it went as high as 69 and it's trading at 63.50, your instinct is probably to scale out or close part of your position or close your position because it has moved away and it has moved away from value and is breaking away. That's just a kind of a natural human instinct to take something off the table as we see that things are moving away from where they've been stuck, and that's what causes, that's the market is responding to this move higher. And for me today, the expectation, the primary hypothesis is for responsive selling to come in at some point. Remember, we have this 1955.50 I expect that it'll likely try to push higher and find resistance between 1965 and 1966 initially, and then I expect it to respond back to 62, test the 60 quarter area or so, and potentially bounce from there. We still have an uptrend going, so that's where the intermediate term and the day time frame are trading from. So I'm not saying that we have selling all day long, but I'm expecting that the early move will likely be to test into the 65 and push lower and become responsive towards 1960 and a quarter, 1955, 1956, where the overnight low is. That's my primary hypothesis. If that proves to be wrong and we come in and we have a small but shallow responsive selling spree, and then buyers come in and push hard and the overnight high is broken, then if you recall from yesterday's YouTube video or TraderByte, the next target up was 71.75. I discussed 71.75, but also said that it is not likely to be in the cards for yesterday, but that is the next key area up. Also 71 was a high left behind, was a weak high that was left behind from way back on October 6th. So that's another reason for that 71.75 test. Next, we have 80 and a quarter, and then I want to remind you that there was a kind of an odd trade that happened, an odd structure that happened way back before the drop up at 1992.50. This is just an incredible target up top. What we had on this day is we opened out of value in range, tested below that day's range, the 71.50, tested down to 70.50. And then found buyers, and the buyers were incredibly aggressive that day, pushing prices basically 22 points, which is 5 points above the expected range on a buy day. And what it did is it closed, if you look at this, it closed right at the high, right near the high, but it also shifted the point of control to the high. What we had is a weak high with the point of control at the high. This is a high probability play for higher highs the next day. The expectation on the next day is we start taking back all of this thin volume and zip right back up to 2000. That's what was expected coming in. However, we had some bad news coming into the market, and what it did is it ended up gapping down and selling off pretty strong the next day, really ripping some people up. That structure still exists, it's still sitting out there. 92.50 becomes a really important target, but there's a lot in the way here. 71.75, 1980 and a quarter, and then I want to remind you again that the micro composite point of control is 87.50. A better view of that is right here. So the most traded price from the middle of August until we dropped on the first day of October is 87.50. So expecting some chop in this area once we get back up there, but then 92.50 becomes the next big target up. Okay, I know it's a lot of information, but I want to make sure that the context stays clear, and that you're trading from the strength of having context as opposed to just looking at some RSI, stochastic, or whatever, which I'm not saying are invalid. I'm just saying that use those tools to kind of gauge the current action, but use context to form your ideas, and then find your spot using whatever indicator you wish, including fibs and whatnot. So I'll leave you with that. Again, trading 1963, we have a gap up, elevated potential for an open drive, although in this situation, we would have an open drive in an old balance zone. So not so great an opportunity for the drive, but We still have a gap up, so we have to be mindful of how we open. Expecting this to be an open auction out of range, and expecting this to find responsive sellers back to 60 and a quarter, and potentially if it pushes through down to 56 or so before the buyers might step in and start moving it back up. Anyway, I want to remind you all that I am leaving for India. I was asked, again, I announced this last Tuesday, but I was asked to be a keynote speaker by Eurex, the German exchange, the home of the Bund, Babel, Schatz, Euro Stocks, and DAX. It's where I cut my teeth as a futures trader and became profitable. So I was asked to be a keynote speaker in Mumbai and to provide some training support, trader development support for some of the shops in India who are trading various products. And so I'll be gone from November 7th till the 21st for the 2 weeks. And I'm going to try to pop in and do a trader bite here and there, but it'll probably be fairly inconsistent between Chicago and India. There's a 10.5-hour time difference, and I'm not sure where I'll be when it's time to do the trader bites. So I just wanted to give you a heads up and let you know that I have not suddenly disappeared, and that I'll be speaking. I'll be at a speaking engagement in India for those 2 weeks. If you have any questions or whatever, just reach out to me through my website, futurestrader71.com. There's a contact page, and there's just plenty of stuff out there. I uploaded the scalping webinar I did with Big Mike Trading last week. You might want to have a look at that. It's a sticky on the front page. It's probably worth a look. And I want to remind you that I am associated with Stage 5 Trading. I'm a managing partner. Stage 5 Trading is a futures brokerage. I don't really do much selling for Stage 5 Trading, but I guess some people ask me why I don't say that that's where I exist. We have a chat room and so forth, and provide future support and trader development at that at Stage 5 Trading. So if you're looking for a futures broker, I suggest you give them a call. Best wishes today. Watch your risk and good luck.